Hello, my name is Dr. Tim Creel, and I will be looking at Chapter 1 of Auditing. Go ahead and share the screen here, bring up the presentation, and start the presentation. Okay, so the definition of auditing, I'm just going to read the definition right out of the book, and that is auditing is a systematic process of objectively obtaining and evaluating the evidence regarding assertions about economic activities and the events to ascertain the degree of correspondence between assertions and established criteria and communicating the results to interested parties. So, um, kind of the summary of the big picture of auditing. And this is really a typical first chapter in a book. It gives an overview of a lot of things that we're going to go in more detail later and summarizes a lot of terminology. So it's a good first chapter and a very typical first chapter in a book. So a summary of the big picture of financial statement audits is the auditor is an independent third party. They obtain and evaluate evidence based on management assertions, which is the financial statements, within a financial reporting network, GAAP or IFRS, and issues an audit report about their findings in this situation. So basically, think about it this way. The auditor is gathering evidence to ascertain, does a company's financial statements follow whatever reporting network that they follow, whether it's US GAAP or IFRS. And then they issue a report about the audit. It basically just saying, do they follow GAAP or do they follow IFRS? So that kind of is a good big picture of an audit. Now, an attestation engagement would also be a term here that relates to auditing. An engagement at which a practitioner is engaged to issue a report on a subject matter or assertion about a subject matter that is the responsibility of another party. Now, this would include both, financial and non-financial aspects. For example, sustainability reporting is a growing market for CPAs. So a CPA could be hired to come in and examine and see, are the sustainability practices that a company is reporting that they're doing, in their maybe sustainability reports, are they actually doing that? That would be an attestation or an example of an attestation engagement. Now, you've also got assurance services, independent professional services that improve the quality of the information. Um, Basically, assurance would be broader than attestation and can include non-financial information such as regulatory compliance, such as if you've got a contract with a company, auditors might come in to see, are you following the contract? That company might send their auditors there to see, are you following that contract? Or might hire an outside auditor to come in to make sure that you're maybe doing all the steps necessary or that you're required to do to fulfill your contract with that other company. So the relationship between auditing, attestation, and assurance services. Assurance services are the big picture. And they encompass attestation engagements, which encompass auditing. So it's kind of like auditing is a part of attestation and is also a part of assurance, which all fall under assurance. So the management assertions, and this is going to be a big thing that you're going to see throughout auditing, is the management assertions. They are existence or occurrence, completeness, valuation or allocation, rights and obligations, and presentation and disclosure. So let's start off. We'll kind of spend a few minutes. We'll kind of spend a minute or two on each of them. Existence or occurrence. Does the balance sheet and income statement accounts do the balance sheet and income statement accounts actually exist? Do the assets listed exist? This is something that you as an auditor would check out. If they're reporting having assets on their balance sheet, do those assets actually exist? It'd be something you would be confirming as an auditor. Did the income statement transactions actually occur? Did the revenue transactions actually occur? If they're showing on their books that they made a sale to X, Y, and Z company, did they actually make that sale? Was it a true business transaction? Um, so that kind of is existence or occurrence. Did they exist? Did they occur? Rights and obligations. Does the company actually own the assets it's showing? For example, a good example of this is consignment goods. So if a company owns a store and they purchase their inventory from an outside supplier, they own that inventory. But what if an outside supplier is selling through them as consignment goods? Then they can't report that as inventory because they don't own it. They're just selling it on consignment for that outside company. Again, this is something that an auditor would look at. Are the liabilities listed obligations of the company? So, are the liabilities listed obligations of the company? Completeness and cutoff. All transactions that should have been recorded are recorded. Verifies this also with disclosures in the notes to the financial statements. So a big cutoff relates to recognizing transactions in the proper period. So completeness, are transactions completely recorded? Did you record two parts of a transaction but not record another? Did you leave something out of a transaction? Um, they look at also disclosures in the notes, because think about it, with transactions, you have to disclose a lot of times additional information regarding those transactions in the notes to the financials. So was that disclosed? That would be the completeness. Because for some transactions, you might record the transaction. What if you were to buy a building? You would probably have to put more information about that in the notes to the financials. Cutoff relates to recognizing transactions in the proper period. And so think about it this way. Here's an example of how this could come into play, cutoff could come into play. And that is, what if you were auditing a company's inventory and they received shipments coming in that went into their store to sell? You would want to look at about the first 10 days after the first of the year to see if there were some shipments marked FOB, FOB, shipping point, or FOB destination. You'd want to look at how those items were shown that came in about the first 10 days of the next month. Because think about it this way. If it's FOB shipping point, then basically that company could own it in shipping and should report it in their end of year inventory if it was shipped before the end of the year. So again, cutoff is making sure that transactions are recorded in the period in which they should be recorded. Valuation and allocation. Assets, liabilities, and equity are valued according to GAAP or IFRS. For example, large assets would need to be valued based on depreciation. They'd need to be depreciated. Inventory would need to be valued at the lower of cost or market. And again, so evaluation, making sure they're valued according to what they should be, according to whether it's GAAP or IFRS that they're following. The appropriate percentage of an asset or liability being shown according to GAAP or IFRS. Depreciation, big example of this. Now, presentation and disclosure. All transactions presented according to GAAP or IFRS, and all necessary and relevant information disclosed in the notes to the financial statements. So, disclosures must be relevant, reliable, and understandable to users. For example, in the notes to the financial statements, companies will put what method of depreciation they use. They're using straight line, they're using double declining, for example. They could use either one. They'd want to put that in there. What inventory valuation method they're using. Are they using LIFO? Are they using FIFO? They would want to disclose information such as this. Disclose information about potential lawsuits, like contingent liabilities. Remember, there are some rules with contingent liabilities that if they could lose the lawsuit, then they would basically report it, might have to report a liability on their books and then put information about it in the notes to explain it further. Um, so the notes are a big part of disclosure. Um, and remember that they're presented according to GAAP and IFRS. So think about it. You would record basically net accounts receivable, which is accounts receivable less the allowance for doubtful accounts. It would be the amount of accounts receivable that you felt like you were going to collect as a company. Um, Transactions must be put to the proper account. You would make sure that things are put where they should go, and information must be understandable to users of the financial statements. Now, one thing about understandability with financial statements to remember is that financial statements are basically should be understandable to people that have a knowledge of business and or accounting. Um, the average person off the street, if they have never worked in business or are never taken a business or accounting course, might not understand the financial statements. But basically, they have to be understandable to their users, to those that, and it's presumed that they have a certain degree of business or accounting knowledge, basically. Now, a couple of other terms here that are important that we're going to see kind of throughout the book. The first one is professional skepticism. And this is basically a questioning mind and an assessment of evidence. So do not just take management's word for it. Corroborate what they say. Now, a big part of an audit is going to be asking questions of management. You're going to say, "I see this happened here. What exactly happened in this with this transaction?" And they're going to give you an answer, and you're going to write it down. You're going to note that answer. But you don't just take their word for it. You go and then you corroborate what they said. Okay, they're right. I can see the backup behind this now. I can see the invoice and the things behind it. But you always want to have a questioning mind, and you always want to be you're asking a lot of questions, but you're always then corroborating what they tell you, their answers. Independence in fact and appearance is very important. And this is going to be in module B, which we'll talk about a little bit with chapter 2. Independence in fact and appearance. So you want to be independent both in fact, and you do not even want to put out the appearance of a lack of independence. One of the biggest things about an auditor is your independence. You must be independent of the situation, must be independent of the companies that you're auditing. That's the only way that you can give, as I kind of say here, unbiased and objective with their professional judgment. Independence is a big part of that. Now, with public accounting, there's kind of an organizational structure, and that is that within an accounting firm, you would have partners who are the leaders of the firm. You would have managers who tend to manage and run individual audits. You tend to have senior auditors who have been with the firm typically a year or two or three, and who take on a little bit more of a leadership role in training staff auditors who are typically auditors in their first year with the company. So this would kind of be what the typical organizational structure you see in an accounting firm is. Now, you've got the four largest firms or the big four firms. You've got KPMG, Ernst & Young, Deloitte & Touche, and Price Waterhouse. These are the four biggest accounting firms. They're known as the big four firms. The big four firms audit most of your larger companies. One reason being is they have offices all around the world. So if you're an international company like Coca-Cola that has a good deal of revenue coming from outside the US, it would be very important for a company like that to use a big four firm because they have offices all over the world. and can better service the needs of those larger companies, and especially more internationally based companies. Now, you also have national audit firms, which are kind of a step below the big four. National audit firms are very big within the US, but they don't have as much international offices, or they don't have as much going on outside the US. If a larger company were to use one of them, a lot of these companies, a lot of these firms do have arrangements with international firms to service certain clients, maybe their international business aspects. So you could use them, but they might not be as good a fit for really large companies. An example would be like Grant Thornton, BDO Seidman. They're big firms. I think Grant Thornton is headquartered in Chicago. They're big firms and they do a lot of business and they do a lot of auditing, but they just don't have necessarily the grand scope that some large companies might need. Regional firms, this would be more firms that are like big in the Southeast or something like that. Like LMBC in Brentwood would be an example, probably more of a regional firm. And a local firm then would be a firm that maybe just had one office in a city. Now, financial statement auditing. Now, these are some of the different services that public accounting firms do. Financial statement auditing. Sometimes they'll do advisory services, which is business advisory services or more kind of information system advising, and tax services. They also might do internal auditing for some companies. Some smaller companies might be too small to have their own internal audit department. So they might hire an outside firm to be their internal auditor. That does occur. They could do governmental auditing for like towns and cities, um, basically small governmental auditing, maybe even state level, could do some things at the state level as well. They could be regulatory auditors, such as performing some kind of audit work for IRS, to make sure that a firm is in compliance with IRS regulations, for example. Or kind of regulatory auditors would be something like, maybe we talked about earlier about sustainability auditing, or what's known as ESG today. They could do some audit work there as well. Now, the Sarbanes-Oxley Act prohibits some services. Now, the Sarbanes-Oxley Act came out in 2002, and it was in response to the Enron debacle. And basically, what the Sarbanes-Oxley Act says is that public accounting firms can, if they're doing the auditing for a company, can no longer do many of the other services listed here. So, if they're doing the auditing, they can't do advisory services, can't do tax services. They're limited. I guess they could say they're very limited in what they could do for tax services. They can't do internal auditing. They can't do bookkeeping. They can't do some of those services for the companies that they could have before Sarbanes-Oxley. So Sarbanes-Oxley says, in an essence, it kind of says, if you're going to do the auditing, that's all we want you to do. If you're not doing the auditing, you can do some of these other services for a company. So a lot of times a company will have one audit firm do their auditing and maybe work with another accounting firm to do some of these other services for them. And that is all for chapter 1. Again, chapter 1's a good chapter and a good introduction to auditing. And a lot of these topics we'll see as we go through the course. Again, my name's Dr. Tim Creel. I am, let me introduce myself real quick, kind of at the end, but I'll introduce myself. Dr. Tim Creel. I've been at Lipscomb for a few years now teaching. I teach some auditing. I teach managerial accounting. Also as well at the university, have taught some various courses, financial statement analysis and other things for the university as well. And I'm a CPA in the state of Tennessee. I am a CMA, Certified Management Accountant, CIA, Certified Internal Auditor. I'm a CFE, which is a Certified Fraud Examiner, and also earned another certification through the Institute of Management Accountants, the CSCA, which is Certified in Strategy and Competitive Analysis. And my doctorate is in accounting. I've got, let's see, an MBA from Lipscomb. So I'm a Lipscomb alum. And I also got a Master of Science in Accounting and have my doctorate is in accounting and also have an EDS, which is an educational specialist degree in online education and educational technology from the University of Missouri. So that is the C. I'm married, two sons, stepdaughter, and they're all pretty cool. Um, and enjoy running, exercising, hiking, getting out in nature, and spending time with my family. Travel's fun too. Enjoy travel as well. But look forward to working with you over this course. Take care, and you all have a great, great day. Bye bye.